You know, when you start taking profits early, you are literally increasing the odds that you will fail as a trader. And people just don't get that.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Hey there, Walter here from the Two Traders Podcast. Today, Darren and I take a look at taking a break. What does holiday time do for your trading? We also look at why Darren uses technical trading tools even though he believes they provide no edge for his trading. We also examine the random walk trading method and the surprising results that this style of trading will probably yield. A critical look at the St. Christopher medal and what that has to do with trading. We also look at my favorite trader interview, and it's not in the Market Wizards trading book. Darren floats his theory about the opposite signal test that he uses before he ever examines a trading system in seriousness. I've got a theory about the first girlfriend and trading exits, and we tackle this in today's session. Darren and I also look at why you need to decide which trading camp you are in and why this is so critical to your trading. You'll see why I split my exits with my trading setups. We also jump into the haunted mansion and the timed stop. And finally, Darren and I go into the most common trading mistake that kills many traders' chances of making consistent profits. All of this and more in today's episode.
So welcome back, Darren. You've had a refreshing holiday, I understand?
Yeah, it's been a really good break. Nearly a month off trading, and like we were chatting before, it's been really good to have that complete break from trading. And like I was saying, I've been thinking about whilst I've been away, and I kind of whenever I come back, I always kind of have a little bit of an adjustment with what I was doing before as well. So I kind of feel like I've got some sort of fresh ideas, not new strategies as such, but just a sort of a fresher way of thinking about my trading. So that's been really good.
Right. So it's not a mechanical thing, but is it more of a psychological thing, or how is your approach evolving?
Because I've always got this like inner turmoil with my trading, because I use technical things like support and resistance and price action, but at the same time, I don't believe they offer any edge to my trading. And it's just kind of I'm forever sort of trying to resolve that in my head, and try and sort of condense trading down to sort of a one-line idea, and make it really, almost like, just like an elegant equation that's really simple. And this is the process, if you like. And I always have trouble with that. And, just it's kind of become a bit clearer for me having that break. It always does when I have a break.
Here's something that I've thought about a lot, and I've tested it, this idea of the sort of the random walk trading account. So let me ask you this. If you had an account where you just flipped a coin or any sort of roll a die, any sort of random thing to get into a trade, to decide whether to buy or sell, and you set up your exit so that it was 5-1, 6-1, 7-1, so you're risking, say, 100 pips to make 700 pips, for example.
Yeah.
Do you think that you would make money on that trading account?
Yeah, you'd make a lot of money.
I think you're right. Yeah.
And not only that, I've seen data that agrees with that notion as well.
Oh, yeah. And this is one thing that I've helped traders who are kind of getting through blocks to see, is that you should be focusing on your exit, right? And you should be focusing on more than that, your exit in relation to your stop. And I know you're a big proponent of having these huge wide stops, right? And I guess some people would say the same about me, really. So I guess one of the things that you learn when you do this exercise, whether it's on a demo account or even just a small account just to test it out for yourself, is you learn that it's hemming and hawing over the reason why to get into a trade, and trying to refine that process is like almost energy pissed down the drain. It's just like, it's not worth it.
Yeah, and I think it's the mindset you hold about those reasons as well. So, you know, I use support and resistance in my trading, but if I don't believe it's an edge, why do I use it? And it's you know, I use those technical elements to define a method, and it means that I haven't got that thought going around in my head, why should this work, why won't it work? Because I know it's just the method is there to stop me behaving badly, if you like. Okay, so I wait for certain conditions to be met. That's a valid trade, and I take the trade. But I know it's not those conditions that are going to make me make the trade win, or it's not going to predict the outcome of my trade. But it just means that I can perform correctly. Okay, so I don't. If I'm having a bad day, I won't just go crazy and just pile a load of random trades on, because I have this kind of method that I follow each day, and that kind of keeps me ordered. So it's for those reasons I use the technical elements.
Right. For some reason, I keep thinking of the old Catholic lady on the plane who has the St. Christopher medal, which is St. Christopher, if you don't know, is this patron saint of travelers, I believe.
Yeah.
And so she feels really nervous getting on the plane, and she's taking off. But because she has this medal, it almost calms her down and makes her feel like she's protected and that her travels are going to end well and everything's going to be safe. And she's not running around the plane going crazy because she's got this St. Christopher medal. Is that a good analogy, or is that a bit off?
Yeah, because I'm sure, maybe not in this instance, but generally, if you think rationally about those things, you know it's not really going to change the outcome of your flight on that plane. But it's comforting us human beings to have something to believe in, and that's exactly what I do with my trading. I use these technical elements, and I believe that method is a good. But at the same time, I know it's those on their own are not enough. It's other elements that are going to decide whether I'm profitable or not.
Yeah, exactly. So, okay, so let me ask you this, because this is one of the, I think I've mentioned this interview all the time. I think this guy is brilliant. There was an interview of this guy in the book called Everyday Traders by Nick Raj. And this trader who, it's actually on my bookshelf, I'll pull it off. I forget his name, but I'll mention it here today. He outsourced his trading decisions, and his whole deal was just to manage the trade and go for a 3-to-1 reward to risk ratio. So he would subscribe to these Forex. He was a Forex trader, and he would subscribe to these Forex signals, and he ran a fund this way. And all he would do with his fund is take the signals that the so-called experts would rattle off, and his job was to put it at 3-to-1. And he said, look, I would only take a loss, or I would take a 300% win, and that's all I ever do. And the reason why he did it was very specific. He thought that it was a good idea to outsource the reasons for his trading and not have that as his own burden. So he didn't have to feel like he had to tweak his trading system because he had nothing to do with it, right? He was just implementing the signals that were given to him. And I thought there's some brilliance there. And I guess my question for you would be, given what you believe about the reasons why you take trades and the structure, would that work for you? I mean, could you do something like that?
Yeah, but he's obviously kind of married to that idea of that's how he's going to decide his entries. But he knows that it's really the fact that his winners are significantly bigger than his losers that means he makes profit. So, yeah, I mean, we're essentially doing the same thing. And I look at those kind of concepts all the time. And the one that strikes me, or the one that I do, is when I look at a system, I think, well, if it works using, you know, say a certain signal is a buy, and I use, say, a 3-to-1 risk to reward, if that tests well and works, then in theory it should work as well if I take the opposite position from the same signal but still use a 3-to-1 risk to reward. So in other words, the signal that is normally a buy for me do sells at those positions, and then it should still work in theory. Does that sound totally crazy?
On the surface it does, but I believe that you're right, because you're talking about the long term here, right? What you're talking about is the long game, right? So like if I set up two accounts and one account would take a sell and the other account take a buy at the exact same time, and they both had 3-to-1, for example, overall both accounts would be profitable, even if at that particular trade one was profitable, of course, and the other one wasn't. Is that what you mean? Or do you mean something different?
That's exactly what I mean. The odds and the probabilities would play out over time. Obviously, the only element you can't control in this is the movement of the market. And if you're 3-to-1, 1,000 pips, and the sort of yearly range is 900 pips, then it's sort of unlikely to happen in that market. So you need to consider the sort of the usual movements of the market within that. But yeah, that's essentially what I'm saying.
Yeah, it's fascinating.
I did a post earlier on my thread on the forum. Yeah, and a friend of mine has been working on a grid strategy, and he had an indicator that just draws horizontal lines, and you just decide what space to put the gaps between the lines. And I was just trying loads of different variations of size of gap, and when you look at it, instantly cries out support and resistance to you, because no matter what size you make the gap, change the time frame, these lines get respected. So you can see why it's so popular, because visually it's very enticing visually. I then sort of showed that you can just trade off these random lines and use random exits, and make a profit. And I just kind of try and get people to try and stop focusing so much on the particulars of entry and the particulars of price action. I think you can use those elements. I think we give them way too much emphasis.
Well, I suppose the same could be said of indicators. You place all this importance on the indicators.
Yeah, and really, it really is the main problem, that people are just basically closing their trades too early. They have a decent method, they're closing their trades too early, so they're not getting the correct risk to reward on their winners, and then obviously the inevitable happens and they start losing money, and then they change their method and they get caught in this cycle because their primary focus is on the entry, whereas all along they're making the mistake themselves. And I've even seen people sort of post backtest results on my thread on the forum where they give their results and then say something like, but I always close too early. And then there's never any emphasis on that. There's never any, well, hang on a minute, actually, is the problem here, me closing too early? And I think it's because we're kind of like rabbits in the headlights, thinking that that's not an important element.
It's like, the guy who's never had a girlfriend, and then the first time he gets a girlfriend, he's like, oh, will you marry me? It's the same thing. You get these trades, and if you have a lot of really poor trades that don't work out for whatever reason, as soon as you get a nice one, you just want to make it count and cash out. And I think this is part of the reason why as humans, we're not set up to trade for profits. We're set up to lose, basically. And that's just the way we're built. And if you're an unusual human, then maybe you are set up to take profits. But that's super rare. I know a trader in Canada, and he was telling me that he's been trading this 4-to-1 system, and he knows, he's got a 37% win rate or whatever. So he just goes for $4 for every dollar at risk, and he's actually decided to move it. He's done a lot of testing. He's decided to go down to 10-to-1. And I think it was actually because I mentioned something that you mentioned in a previous podcast or something about the number that was best was 10-to-1.
Yeah.
In the data or something. Someone was testing or something. What was that about?
It was someone testing a simple trend line break strategy.
Right.
I think 10 pips risk for 100 pips reward was way, way more profitable than anything. But at the same time, 40 pips risk for 10 pips reward was also profitable. So the extremes were profitable. And then when you got near the center and you were sort of trading more on a sort of 1-to-1 risk to reward, then that's where the amount of profit became very low, or even losses were occurring. So, yeah, I mean, I'm always banging on about this trade the extremes. Decide which camp you're going to sit in. Are you going to go with a wide stop and have a high win rate, or are you going to have a tight stop and a high risk to reward? And I think, making that decision to sit clearly in one camp or the other is really important. Unless you can, sit in both camps at one time, and sometimes use a wide stop and then tighten it up. But it's just kind of taking that focus away from the solely on the entry, really.
Yeah, right, exactly. And as traders, we move away from that as you sort of age and get experience. I think you get further and further away from the perfect entry, and you get more into, okay, let's look at risk. Let's look at how am I maximizing, maximum favorable excursion and all that sort of stuff. Where you're just trying to figure out, okay, how, what's going on here with these trades? How can I adjust what I'm doing, even though I keep doing the same thing, but in a slightly different way in terms of the exit, so that I can milk more money out of this, milk more pips out of this. That's kind of the natural progression.
Tell me something about your thoughts on the exit, because I know you were telling me, I might be wrong here, but from what I've seen, when you take your trades, you decide on a first target and a second target. And really, once the sort of trades kind of go in your way, are you trading to that target, or letting it come all the way back to your entry, or are you taking notice of price action in between those targets?
Okay, so normally what will happen is I'll have a first target and a second target, and sometimes I'll have a third target. So typically, a typical trade would be entries triggered, right? Which means it basically has to make a new high or new low. And I mean, that's just I don't know. The number of losers that occur because people want to get in on a retracement, to me, is maddening, but that's a whole nother topic. So then what happens is, as it approaches target one, ideally it would blow through target one. And what I mean by that is, if target one's a support and resistance area, and you say what you want about support and resistance areas, but we as humans, as you've touched on this today, we as humans can see patterns. So they're really, really simple and easy to see. And that's why I love trading these suckers. So if it blows through that level, so if it's a resistance area and it closes clearly above it, or if it's a support area and it closes clearly below it, then I'll move my stop to essentially break even and hope and pray that I hit target 2 and target 3.
Yeah.
That's the typical thing that I do. That's basically, it's simple as that. Yeah.
Let's say, for instance, say your first target is at 3-1, and you get to 1-1, and you get something like a pin bar against you, or something, some sort of negative looking price action. Do you stick with the trade, or do you would you ever just close your trade out because of the price action prior to hitting target 1?
The short answer is it depends. So occasionally what will happen is I have like a time stop. I learned this from this guy who lived in a mansion in San Diego, and I worked for him for a little while. He was a fascinating guy. He had all these mad interests, and it was like walking into like a dusty old haunted house. He had stacks of papers and books and all these things. Anyway, he traded, but that was only one thing that he did. And he had all these other vast interests. And so what he taught me was, when you are trading and you take a trade, if you wait too long, the reason why you got in that trade is sort of like the market kind of forgets it. And I do believe this about price action. I do believe that price action patterns are really, really good at highlighting what's likely to occur in the near future. But they're not so good at what's going to happen 20 candles from now, right? So my whole thing is, when I take a trade, I want momentum behind me. So if I'm in a trade and it just sits there for 10, 12 candles and literally goes nowhere, a lot of times I'll just pull the plug and say, well, time stop. I've waited, this was supposed to be momentum, was supposed to be behind me, and it's not going anywhere, so I'll pull it. The other thing that I'll do is, if really, really close to my target 1, right, but doesn't quite get it, I'll also move to break even. And at that stage, okay, well, this is house money now. Maybe I should have had a target somewhere else, but I'm not going to move my target, right? Keep my target where it is. If it comes back and stops me out at break even, it's a trade that never happened in terms of, the way I look at it. So those are the two most common, ways of getting out of a trade.
Yeah.
I know you don't do that, right? You just wait. It either stops you out or it hits your target.
Well, I think some people perhaps as good at reading price action, perhaps, or I think the fear is so much losing what is already like in their mind a winning trade. They perhaps in the moment, that's definitely a negative looking bar, I better close. And they kind of then get stuck in basically, anything at all that is not price racing to their stop, they see as a negative thing and close, and they kind of get trapped in that thing of actually never actually getting to target one, and that's something that I definitely had difficulty with. So I did, I've tried to kind of evolve rules that, although I might manage my position, it'd more likely be maybe a reduction in my stop or at the most a move to break even, rather than closing out. And I think for a lot of people that can be an issue.
Yeah, it is. I agree. And you bring up two really good points. One is if you're taking profits too early, that's a bad habit to get into, because what that does is it shifts the probabilities that you're going to blow up your account. So if you have really good numbers in terms of your win rate and your reward to risk ratio, you can get a handle on knowing what your risk of ruin is in terms of, this is all probability theory, right? So it's statistics, and you can argue whether or not statistics are useful or viable or whatever, but according to the numbers, right, and what the statisticians will tell us, they'll say, well, you're 0.8% likely to blow up your account. Well, now, as you start taking profit too early and you shift your reward to risk ratio in the wrong direction, that, less than 1% likelihood of blowing up your account, that might become 33%. It could literally shift that quickly, that fast, if you take profit too early. So this is, I think what you're bringing up here is a huge problem that a lot of people aren't aware of, because they think of it in the same way. They think, well, I'm taking 93 pips instead of 100, right, for this. But that is a dangerous habit to get into. And as you do that and you whittle away your profitable trades, you reduce your reward to risk ratio and you just inch closer to destruction. And people don't realize that. The other thing that I think you bring up is, people say, well, I'm in this trade and then I get a kangaroo tail against me, so okay, I better get out. Well, if you trade the way I do, and I'm not saying it's the best way, right? I'm just saying the way I look at it is the market shouldn't, if I take a trade, then the market is so expanded and volatile and in a swing mode that in theory, if a kangaroo tail prints halfway between my entry and my target, that kangaroo tail is printing in no man's land. There's no support and resistance there, and therefore should be ignored. You know what I mean? So it's not important. The only kangaroo tail that matters is one that prints at a level where the market has repeatedly remembered to reverse there. So when people say, oh no, there's a kangaroo tail against us, I say, who cares? There's nothing behind it. It's got no teeth. So just forget about it and let it go, and let the trade unfold. If it ends up being a loser, fine. But, the point is, getting into this mentality of taking quick profits, although it feels good, is dangerous. And I think a lot of traders don't understand the risk of ruin, and they don't understand this concept of, when you start taking profits early, you are literally increasing the odds that you will fail as a trader. And people just don't get that. So I think that those points you bring up are just spot on. Yeah.
Yeah, because it pushes you then where you're sitting in neither camp, because you're taking a small stop loss, which generally is going to give you a low win rate, and then you're not getting that risk to reward. So you've kind of, you're sat on the fence really with your money management strategy, and I think that's like a massive problem. It might even be one of the main reasons that people fail. So here's something else. So I'm saying that these technical elements, really don't matter as long as you've got the risk to reward, etc., etc. And then I look at certain ideas and they seem to work only on certain pairs, and that one really flummoxes me, you know, because I'm a strong advocate of saying, you know, if it works on, you know, a low time frame, it should also work on a high time frame, and so on and so forth. And so, you know, then, you know, I'm kind of saying that patterns don't really matter, and you can trade random patterns. And then I find patterns that seem to just work on one or two pairs. And, you know, so there is, and what I'm trying to say is, you know, take what I'm saying on these elements with a pinch of salt, because there's always exclusions to the rules. And as an example, there's something I trade which is looking for the high and the low of the day. You know, with you look for support and resistance to add teeth behind your entries. And I'm kind of looking to see if we're trading off one of the extremes of the day, if we're turning around from a new high on the day or a new low on the day. And this works superbly on the euro dollar and the pound dollar. And what I'm doing, I'm basically forgetting the Asian range, and then I'm waiting for price to spike out to a new extreme and then turn around. Okay, and I'm using that new level, that new price level, and the reversal as an indication that there's a support and resistance level there. So I don't even need to draw the line. I'm looking for the movement of price. I don't want to call it price action, because I think it's more than that. The actual candle shapes don't matter to me. And it works superbly on the euro dollar and the pound dollar, but on the pound Aussie or the euro Aussie and things like that, it doesn't work at all. And that's because those patterns on the euro dollar and the pound dollar are nearly always happening in London and New York session. So there are patterns that are significant to certain instruments as well, and I think those are much harder to find, but maybe more useful.
Yeah, that's fascinating. So I guess essentially what you're saying is, in that case, the reason why this system doesn't seem to work is because the market participants are not in this, you know, it's not traded at the same volume level. So for maybe the pound Aussie is traded more often, or there's more significant volume in Asia than there is the pound dollar or something like that.
Yeah, sure. That's clearly what's happening. It's just you know, when I first noticed it, it was just surprising to me, because in the past I would say, no, well, you know, if there's a pattern that exists on the pound dollar, then it's most likely going to appear on all other liquid pairs as well. And it was quite a surprise to me to find that there were. And I've recently seen more people do, you know, really detailed research on, say, like the difference between the stock market and the forex market. So yeah, I mean, there are patterns that are significant, but I think a lot of the time we as traders focus on, you know, the illusionary patterns.
What's interesting to me is, you know, there's all this talk about the algorithms and how they're just ruining it for traders, and yet probably the number one pair that has, you know, more robots trading it, more algos are in the euro dollar than any other pair in Forex, right? And what you've just highlighted is a very simple human determined strategy that you can use on this pair, and yet everyone else is throwing their hands up going, oh, you know, the algos are ruining it for us, this is terrible, the end of days, and so forth. And yet that pair seems to behave in a, you know, as you can see, for your trading, it seems to behave in a really rational way. And, you know, algos be damned, you're still able to see a very simple way for it to establish a range for you to trade it.
Yeah, definitely. You know, well, go and test it for yourselves. Look at the euro dollar and, you know, trade the turning points at the current high and low of the day, and it's you know, very. I do a bit of hedging as well, but I'm not going to go into that on this podcast.
Sure, yeah. I think we don't have time. We're running out of time here, but I wanted to just talk about a strategy that I learned from a guy who was. He was interviewed to be in the Market Wizard, or they wanted him in the Market Wizards book, but he refused. He didn't want to have any of that. But it's tangential to what you've talked about today. So I'd like to leave that for another podcast. But I think because it's fascinating to me, and it's something that's almost like an overlooked thing about the day, and yet I'm sure some people look at it, but I just thought it was a really cool way to to set up a trade for the day. Anyway, so any final thoughts, Darren? It's good to have you back. I'm glad we're both feeling refreshed. I'm feeling refreshed because I'm about to take off on a holiday, and you're feeling refreshed because you come back from your holiday. So I think this has been a good session overall.
Yeah, holidays are great, Walter, and we spoke at length about that in our sabbatical podcast. But yeah, great to see you again, mate.
All right, well, have a good one, and good trading to you.